What's up, everybody? So, in this one, I'm going to be talking a little bit about my trading model. I use this model that was formulated over the course of 3 years. It's from ICT Concepts, and I just want to state that in the beginning so we're on the same page. Um, as my mentor, and I want to talk a little bit about the Amazing Eight model, what it is. We're going to talk about the logistics first, then I'll run off into some examples and all that good stuff. So the Amazing Eight model is a model that appears every single day, Sunday through Thursday at 8 p.m. It's a one-to-one gearing model. So let's just go down the list. It's one pair, meaning micro E-mini S&P or the E-mini S&P. Um, one time of day, 8 p.m. Eastern time. So wherever you're at in the world, you're gonna have to adjust your time zones to that. So for me being in Central, I'm 1 hour before, so I'm showing up in my charts at 6:50, 10 minutes before um it actually opens up for my model to take place. So 6:50 Central is 7:50 Eastern. So it's one entry time. Now I do want to take off the part where it says close time being this because it can have different close times. I do want to take that off. I took these screenshots relatively months before I decided on dropping this video. So I really never had the chance to go in and actually delete that close time part. So I just want to note that you're going to have different times your setups are done. So one trade per day, no re-entries. If you take a loss or a win, um, that's that. You're getting one setup per day. It's a one-to-one risk reward gearing model and flexible handle gearing. So there'll be some setups where I may use 3 handles, some setups where I may use 5 handles, some setups where I may use 10 or 15. It all varies depending on the context of the setup. And you'll see that kind of when I explain it later. So the trading style is fix or set and forget, meaning when you take your trade, you walk away. It's a continuation or contrarian model, meaning it's a model that can continue if price is going higher or lower, or it can reverse from a high and go lower, or reverse from a low and go higher if you're in a downward market. There's always pre-calculated risk. So I do want to note that I'm not a professional advisor. I don't you know, really have the right to be telling people how to do their risk measures and all that good stuff. But I do want to note that, I want to say that you can lose more than you risk. But with this model, it's what I do. I just felt like it would be my due diligence to share it and give it away for free. So, like I said, always pre-calculated risk, meaning whatever you're deciding to put on the trade, you're going to actually put that on in a calculator rather, and you're going to calculate your handles, your amount that you're risking. So, for an example, hypothetically, right? If let's just say hypothetically, I was risking, let's say, $100 on the trade, right? And I was risking a 5 handle setup. I would take $100 divided by five. And let's say I was trading the micro E mini S&P. That's $5 per contract because E mini S&P is $50 per contract. It would be four micros put on the line. You see what I'm saying? Like I said, it's Sunday, Monday, Tuesday, Wednesday, and Thursday. So let's go to the second part. The non-permitted conditions. I do want to eliminate the NFP Thursday because NFP Thursdays can be traded. Like I said, I made this model when I was kind of still ironing out the details, so you just have to bear with me on how I explain it. So days with news at session are avoided in U.S. bank holidays, and later on we will get an example with that. It's in the Asia session. It's the time frame 15-minute only. We don't switch back and forth. You have this one time frame that you're going to stay on. Um, and yeah, we already went over all this other stuff. And the setup is entered at 8 p.m. Eastern time at that candle open. So let's go to what it means. For an example, I was back testing and I found a good example earlier. And what back testing means is I was looking at old price moves where this happened, and I'm collecting the data day by day, and I have a year's worth of that. You can find that Amazing 8 Futures on X, and I have a pinned post showing what the model is, as well as all the data up until this point from a year's perspective on a Google Doc. So you can go in and study those example purposes. Those are real examples. If I took a loss, I journaled as a loss. If I took a win, I journaled as a win. So let's go to the 18th of last year on the February. So you can see right here, we had news at 8 p.m. I would have avoided this day completely. right? Let's go to the day before that. All day we had news. It was a bank holiday, so I wouldn't trade that day at all. Now, let's go show you. Let me go show you some actual examples of how I run through the process of my model and all that good stuff. So let's go to. Better yet, we actually have an example coming up pretty soon. But let's go look at. Let's say, for an example, what was this? Let's go look at yesterday. So you got to keep in mind. I do want to note when I back test, I don't look at what happened prior. I'm gonna note that I actually took a loss on this one. And I'm gonna say when I'm back testing, I don't try to see what the market did and try to like cheat it. Like once the model's down, you don't want to do that. But while you're learning, you do want to see what the market did at that window of time. And you're just trying to learn. It's basically reading the tape. You're learning how to spot these moves before you actually try to go in and spot them. So since I know how to look for them, doesn't mean I get it right all the time. Doesn't mean I don't take losses or have multiple losses in a row. It just means that the likelihood of it doing a certain specific move will be in my favor, and I'm going to manage my money so I can stay in the game for the long run. Because it's not a matter of winning or losing; it's a matter of probabilities over a large sample size of time. So, for an example, I took a loss on this one. I'm going to note what I did to give y'all this experience because I was right on the move, but the market just didn't have enough. Excuse me, that was my alarm to actually look for my model right there. So I was right on the move, but I didn't have the market. Excuse me, the market didn't have enough oomph to actually get down there. So the model is you want to mark the next draw on liquidity. So price had rallied higher, so I was anticipating it to continue lower. This is a fair value gap SIBI. So what it means is a fair value gap, sell side imbalance, buy side inefficiency. As you can see, we had this space right here, and when you draw that box out, basically price is inefficient above this area. So this is a sell side imbalance, buy side inefficiency. And there's plenty of content on that on the Inner Circle Trader YouTube, um, talking about inefficiencies and liquidity because the market bases its moves off two premises. Time being the very first thing, time is the most important aspect of it. And price can either book higher or lower based off liquidity, aka stops above old lows, old highs, or relatively equal lows or highs, or inefficiencies where price needs to go back and eventually fill that space. And like I said, there's plenty of content on that on YouTube at Inner Circle Trader, YouTube for free. So my model is I mark the next draw on liquidity. So as you can see, price left these lows open, so it's going to eventually want to reprice there. So basically, that's your target. And what an inefficiency is, like I said, I'll show you an example of an inefficiency. So this is a inefficiency. As you can see, we had this. As you can see, price came down and filled this inefficiency. We must include the volume imbalance, and I'm not going to get off into all that. A volume imbalance, though, I will say is basically just a period where, well, a space in the market where price basically, how do I explain it? It's like a gap. It's like a space. So, for an example, this is the inefficiency. So price came down, filled that, and it started rolling higher. So basically, the first step of the model is knowing your target, sell side liquidity. So I'm looking for it to go lower. Next, after we check news. So now we're on step three. Mark the fair value gap for entry purposes. So there's four types of fair value gaps. We have I'm gonna just type it out for y'all. Fair value gap, BISI, buy side imbalance, sell side inefficiency. Fair value gap, SIBI, sell side imbalance, buy side inefficiency. We have a bullish inversion fair value gap and a bearish inversion fair value gap. And I'll just kind of talk a little bit about what those two fair value gaps are since we already talked about BISIs and SIBIs. So this is a SIBI and this is a BISI. So as you can see, price ran down into this buy side imbalance, sell side inefficiency. closed above it, and then it rallied a little bit higher. I do want to note that this fair value gap BISI, when you extend this out, I want to see this act as an inversion. What an inversion fair value gap is, if price is looking to run lower, then you want to see this bullish PD array act as a PD array that can push price lower. So if I drew an orange box, right, I want to see price go through this buy side imbalance, sell side inefficiency, and keep going lower, right? So I took my sell and I put 10 handles because that was enough for price to give me a good piece out the market, but not demand it to go all the way to this target. So I ended up losing on this trade because it respected it as a buy side imbalance, sell side inefficiency. So I ended up losing. I basically just got that idea wrong, and that's okay. So I thought price was gonna close below here and keep going at least lower to this target, but I just got it wrong, and that's all good. So now I want to go note another trade example. So basically, I want to note earlier that I was right on the idea. Price just didn't have enough oomph to go down here and hit these 10 handles. So if I would have done, for an example, let's say 7 handles, then the short would have won. You see what I'm saying? So now I'm gonna go do another example. So Monday let's go do Tuesday the 24th. So go to 8 p.m. So boom, let's get rid of all this. So Monday the 24th, Tuesday the 24th. So let's go to Tuesday the 24th. Check news. There was news, so no setup for this day. Let's go to Monday the 23rd. So Monday the 23rd. So let's go to 8 p.m. Oh, that was Sunday. So let's go to Monday the 23rd. So boom. So mark the 8 p.m. time window. Now, mark the next draw on liquidity or inefficiency. So price is rallying higher. We have these relatively equal highs, as well as a fair value gap SIBI low. So we have orders above this high, as well as this sell side imbalance, buy side inefficiency right here in the form of a sell side imbalance, buy side inefficiency. So basically, price needs to rehire eventually and fill this inefficiency in. So that's our target. So buy side liquidity, buy side liquidity above those relatively equal highs. Make that blue, put it at the top. So that's my target. Now we need a fair value gap. So this is a bullish inversion fair value gap. So if I take this fair value gap, SIBI, but I want to see price actually use it to make price continue to go higher. So if the algorithm is going to code itself to continue to go higher running through this, so I don't want to see price respect this as what some people will call support or resistance, because it's not support and resistance, it's not supply and demand. I'm just going to note that. I'm not bashing anybody that uses that, but I want to note that this is a clear difference because the market runs on time being the most important thing. Time is the x-axis, price is the y-axis. So I just wanted to note that time is the most important thing in this. So this sell side imbalance, buy side inefficiency is actually going to be used as an inversion fair value gap for price to run higher. So I wouldn't look for shorts. I would actually look for price to continue going higher. And those are the 4 fair value gaps that we listed earlier. So since I'm looking for price to go higher and we're using this inversion fair value gap to go higher, let's say I put my stop loss here at 10 handles below it. That's good. You never want to put your fair value gap in a you never want to put your fair value, your fair value gap. You never really want to put your stop loss in a fair value gap unless it's a low liquidity run, low resistance liquidity run, meaning you're not expecting a lot of drawdown. High resistance means it's likely to take a while and it's probably going to be harder to actually hit your target. So I'm putting my stop loss below this inversion. Take the trade at 8. and you're out. So you're done. That's all you do. And I'm actually going to maybe mark up the setup for today because it's literally 6:58 my time, so it's 7:58. Um, it's 7:58 Eastern time. So I'm gonna go look for my model actually right now. So this setup right here, this setup right here is currently 8 p.m. So price already ran these highs and left these relatively equal lows open. So I'm gonna look for price to continue lower. So my next draw on liquidity is this sell side liquidity down here at this low. Put that at the bottom. Now I need a fair value gap for entry context. We have a fair value gap SIBI that could be used right there. It's a small one, but if I zoom in, if I zoomed in, we can use this one. And we're actually going to use this one, or we could use this inversion. Now, I kind of like this inversion better because it's just a bigger fair value gap. My eyes spot it easier. You don't really have to be too fickle on which one you use. It's just more, what does your eyes see? So if someone knew their contract size, meaning if they knew how much they were going to risk divided by the handles, so a setup like this, I would probably risk 10 handles would be good for a setup like this because 10 handles is not required to hit this sell side liquidity. So it's kind of, I'm aiming for the low hanging fruit. Um, so let's just say, for an example, if I was risking hypothetically, let's just say $100 divided by 10, divided by $5 per contract, I would put 2 contracts on this trade right here. I'm not going to log in and demo and all that because I'm really just trying to do an introduction of this model. Um, so I'm just going to leave. This would be the setup for the day though. And how I would journal it is whether if I won or if I lost, I would say today is Thursday. Put this on 16. So let's say Thursday, February 26th plus 1 data point. If I won, I would say -1 data point if I lost. But this is the setup, so we're gonna see what this does. I'm not gonna actually watch it. Y'all can come back to this video reference point later on and see what it did. But I will be taking a sell right here with my stop loss above up here at 6,900 and a quarter, my target at 6,880 and a quarter. And I would take that sell, let it run, do what it's going to do, and then journal what happened later on by saving that by coming up here to the top right and copying the link. And then once it's done, you can go in and save these on an individual basis. But that's pretty much all I got for this video. I just wanted to explain the introduction of this model. I might do more videos in the past if y'all like this. But if you're interested in any more signals or any consultation calls. If you have any questions, you can leave them down below in the comments. Once again, the data points of all the saved data from February 26th of 2026 to February 26th of 2025 will be at the Amazing 8 Futures on X. Click the pin post, and I have a Google Doc offer free where you can go in and see that data and do your homework and study up on this because this is something I take a lot of pride in. I give all glory to Jesus Christ for giving me the strength, knowledge, and the utterance to be able to express this model. It's a gift, and I just wanted to share it with y'all for free because he's really blessed me. So that's pretty much all I got for this one, y'all. Until next time, take care.